so much for the financial statements. Let's talk about ratios, financial ratios. If you read the chapter, you've already found out that there are many different types of financial ratios. Okay? They can measure the performance of business in many different ways. Okay? But regardless of which textbook you use, the first thing they present is liquidity ratio. Why? Why do you think so? We always talk about liquidity ratio first. You know what liquidity is, right? Why is it so important to have liquidity? Haesung? Why is it so important to have liquidity? Yeah, that's right. That's the perfect answer. I just gave you the answer, right? Yeah, you're going to talk about many different ratios like asset management ratio, debt management ratio, all kinds of things, right? But if you are not managing your assets in the best way, if you are not managing your debt in the best way, you still have some time to make some changes and improve. Okay? It's like you're just feeling a little weak, you haven't exercised for a long time, so your muscles are a little bit, weaker and diminished. Okay? So maybe over next a few months or a year, you can exercise more and get yourself strength back, right? But if you have a cash flow problem, if you have a liquidity problem, it's like a heart attack. Okay? You're in bad situation, terrible situation, because if you don't have enough cash to pay the bills, right, then you may have to declare bankruptcy. Okay? That's why we talk about liquidity ratio first all the time. Okay? The most important, or I guess most prominent, liquidity ratio is current ratio. It's simply the ratio between the current assets and current liabilities. Yeah? What are current assets? I think I talked about it last class. Yeah? What are included in current assets? Most importantly, cash. Okay, and marketable securities. What are marketable securities? Yes, stocks and bonds and something CP or commercial papers, something you can sell in the market and quickly obtain cash, right? So it's not as good as cash, but it's pretty liquid, okay? Highly liquid, okay? Because there is a market for them, okay? And account receivables, okay? Inventories, and prepays. Okay? What are prepays? You already made payment for this thing, something like insurance. Okay? Suppose you make insurance premium every 6 months. Okay? Pay insurance premium every 6 months. Okay? So you've already paid the next 6 months insurance. Okay? It could be fire insurance, auto insurance, or whatever. The workers' compensation insurance. Right? You have to buy a lot of insurance when you run the business. Okay? If you still have 5 months left, right, then it can be considered an asset, right? Because, well, if something happens, and you decide to close the business today, right? Maybe you can get some refund, okay, of 5 months premium, something like that, right? All right, so those are current assets. What about current liabilities? When we say current asset, and fixed asset, which is long-term asset, what's the difference? What's the criterion between the separating current assets and fixed asset? Yes, 1 year. We use 1 year period, right? So if you can convert these things within 1 year, okay, it could be considered current asset, right? Well, I'm sure you can argue that some of the equipments you have, or your plant, you can sell them within 12 months, right? True, right? But it's just a general custom, right? We consider these items more liquid than your equipments and plants and facilities, okay? Okay, so the current liability, the same thing. Current liability means these are the items you can pay within 12 months, okay? Or you are required to pay within 12 months, okay? Accounts payable, you purchased material and some components from your suppliers, okay? And you owe this money to your suppliers, okay? Typically within 12 months, okay? NP, what is NP? Notes payable, okay? Again, that's an IOU, just like bond, okay? But if the maturity is longer than a year, we call them bonds. If it's less than a year, we call them notes, okay? So notes and bonds are the same thing, okay? Notes payable, okay? Taxes and wage accrual. I explained the accruals last class, okay? What is an accrual? Like tax, right? I think you know the answer, right? But if you make the income tax payment every 6 months, right? So you owe the tax, let's say 3 months into this period. I mean, today is March, okay? And you need to make the income tax payments by the end of June, okay? Then you have still, you've already had 3 months periods, right? So if you expect your income tax to be 100,000, right? We are in about half the period for this 100,000 tax obligation, right? So that means right now you owe about $50,000, okay? So that's what we mean by accrual, okay? If you pay your employees at the end of the month, right? If this is the middle of the month, right? Then you already owe them half of their monthly salary, okay? So that's the idea of accrual, okay? All right, so liquidity ratios. First one is current ratio, current assets divided by current liability, okay? So liquidity ratio is basically a measure ability to meet short-term financial obligations. Financial ability to meet short-term financial obligations, right? You're going to be required to make these payments within short period, right? How ready, or, what's your ability to do that, right? So when you divide the current assets by current liabilities, what will be the number like? The larger the better, or the smaller the better? Larger the better. It better be larger than 1, right? If it's less than 1, you are in trouble, right? Because compared to what you owe, what you have is smaller than what you owe, right? So you can be considered in trouble, okay? Yes, typically it's significantly larger than 1, okay, in most of the companies, okay? quick ratio, slightly different. Okay? You just subtract inventories from current assets. Why? Why do we subtract inventory? So out of all those items, we just eliminate inventories. Any idea why? Because inventories are considered least liquid, right? Least liquid item among these AR account receivable. I mean the current asset items. Okay? Because depending on what type of product you produce, right? If you produce some general items, then your inventory may be liquid. Okay? In other words, you can sell them in the market quickly, right? But in many cases, your items are specialized, right? Some components you supply to, say, Hyundai Motors or Kia Motors. The company I am working as an advisory board director, it's a plastics company, okay? And they make some plastic components that go into Hyundai cars and Kia cars, okay? And where can you sell these items in case you need more money? They are specially designed for these particular cars and particular models, right? So there is no other market for this inventory in case you have a lot of inventory, okay? And just because you are in financial trouble and need more money, Hyundai or Kia, may not be willing to buy these items, okay? We'll talk about the inventory management just in time production later, just in a few minutes, okay? So basically there is no market for inventories, okay? If it's a finished product, okay? If you're talking about inventory of components and material, the same idea, okay? So you may be purchasing some components, and if you are a computer manufacturer, right? You purchase some hard drives or LCD screens or whatever, right, from your suppliers, right? And it may be difficult to find anybody who are willing to purchase these items. Okay? So usually it takes a lot of time to get rid of inventories in case you need to. Luckily, fortunately, you found some buyers. Okay? You may have to give a significant discount in order to sell your inventory. Okay? So inventory may not be a good item to hold, okay, as a current asset. Okay? So that's the idea of quick ratio. So you can say quick ratio is more stringent measure of liquidity, okay, compared to current ratio. Okay? So there's a nickname of quick ratio is acid test. Acid test of liquidity. Okay? Or simply means it's more stringent measure. Okay? All right. Next item is asset management ratios. Asset management ratios are intended to test revenue generating efficacy of each type of asset. Efficacy means effectiveness. Okay? How effectively does each asset generate revenue? Okay? That's the idea of asset management ratio. Okay? So as you see here, we're talking about different types of assets. The AR, account receivable, okay? Inventory, fixed asset, total assets. We have, well, if you look at other financial sources like Yahoo Finance and so on, I mean, the annual report of any company, you may see some slightly different version of these ratios, and you will probably see a little more than what we present in our textbook. Okay? So remember, we're talking about some principles here in our textbook. Okay? So there may be some different versions and different types of ratios, okay? But these are more typical ratios. Okay? Average collection period is account receivable divided by annual credit sales divided by 365. All right, so from this you can get the idea. What's at the bottom here? It's a denominator. Annual credit sales divided by 365. What can you say? Daily credit sales, right? Daily credit sales, right? So compared to the daily credit sales, how big is your account receivable? I mean, account receivable is outstanding amount of money you expect to receive, right? You've already made the sales, but that money has not been collected, okay? And we're talking about the ratio here, okay? So average collection period, you can say it is a measure of average number of days that account receivable remains outstanding. Basically, on average, how many days it takes to collect your sales. That's the idea. Yeah? On average, how many days does it take to collect your sales? Okay? So the unit of this measurement is days. How many days? Okay? All right. So account receivable here, this figure, typically they use account receivable figure in the beginning of the year. Okay? In the beginning of the year, how much was the account receivable? And we divide that by the daily credit sales. Okay? Then we can find out on average how many days it takes to collect the sales. Okay? And let's say it comes out to be 35. Is it good? In other words, for this particular company, it takes about 35 days to collect your sales. Is it good or bad? Really? It depends, right? The right answer is it depends, right? Because the reality is in industry, in business, there are credit sales, right? In other words, you give some leeway, you give some time for your customers to pay, right? So that's the general business custom, business practice, right? So it depends on your credit policy, but is it good or bad? The thing is, you have to compare to your competitors or the companies, other companies in the industry. Okay? It's called the industry norm. Industry norm. In other words, what's the general practice in the same industry you're in? Okay? If you're in computer manufacturing industry, right? What do other companies do? Right? How many days do they give their customers to pay? Right? So if this average collection period comes out to be greater than industry norm, okay? Or let's say significantly greater. Suppose the industry norm is 30 days, but it takes for you about 45 days to collect. Right? Is it good or bad? Bad, right? Because that means your cash flow is not good. Amount of money you are entitled to. You already sold your products to this company, shipped your products to this company, but they are not paying, right? for a long time, right? So you have to compare it to the industry norm, right? So if your average collection period is significantly higher than industry norm, you can say your credit policy is too liberal. Credit policy is too liberal. You're giving too much time, right, for your customers to pay. Okay? And every company has their own credit policy. Okay? And when you sell your product, ship your product, you usually include the invoice. Right? You know what invoice is, right? Invoice makes clear what the company's credit policy is. It's typical credit policy is something like net 15. Somewhere on the invoice it says net 15, right? What that means is this total amount is expected to be paid in 15 days. Okay? What this means. Okay? Sometimes another popular policy is 210 net 30. 2/10 net 30. Okay? What that means is if you pay the total amount within 10 days, you can take 2% off. So you're giving 2% discount if the customer makes the payment quickly within 10 days. Right? Or if you don't do that, the total is due in 30 days, net 30. Right? So that's those are typical credit policy of the companies. Okay? So you can figure out, based on the industry norm, whether your company's credit policy is too tight or too liberal. Okay? What can be wrong? If it's less than industry norm. Industry norm is 30 days, but your average collection period is 15 days. Is it good or bad? Good? Okay. Well, it is good in the sense that your cash flow is fast. Okay? You're recovering the cost fast, right? The downside is your credit policy may be too tight. In other words, your customer may not like it. Okay? They may complain that, well, other companies give me 30 days, right? Why do you guys insist on 15 days, right? So you may lose customer, right, in that sense. You may lose sales, right? So that's why you need to pay attention to industry norm. Okay? Compare your policy to industry norm. Okay? One other item is released fund. Related to this average collection period, we can talk about released fund. Okay? Released fund is number of days difference times average daily credit sale. Number of days difference times average daily credit sale. Well, what do you mean by number of days difference? This difference. Suppose it takes 45 days for your companies to collect. The industry's norm is 30, right? Then the difference is 15. Okay? 15 times, suppose on average your daily credit sales is, say, 10,000. Okay? $10,000. A pretty small company, I'd say. Right? Then the release fund is what? $150,000. Can you explain the concept? What is $150,000? What's the concept of released fund? Any idea? Yeah, yeah. The story is because of this difference, because of your collection is slower than the industry norm, right? About $150,000 is tied up. This is your money that you could have used for some other purpose. You could have invested, or you could have purchased material or whatever, right? But because your collection is too slow, slower than the industry average, okay, this money is tied up, right? So if you can somehow bring down the average collection period to industry norm, okay, then $150,000 could be released. In other words, it will be made available to you. Okay? You could have used $150,000 to, whatever, pay off the debt or purchase more material or more equipment, right? So that's the idea of released fund. All right? Okay, the next ratio is the inventory turnover. Inventory turnover is cost of sales divided by average inventory. Cost of sales, again, it's the same thing as production cost. Okay? How much money does it cost for you to produce your output, okay? Your products? Okay? And you divide it by average inventory. There are a few different ways to calculate average inventory, okay? Because inventory may fluctuate, right? Sometimes high, sometimes low, right? So you want to calculate the average level of inventory, okay? If your inventory is pretty smooth, if your inventory over the year is pretty constant, or it just increase or decrease in a linear fashion, like this, without too much fluctuation, right? Then you can do average inventory by beginning plus end divided by 2, right? You can calculate average inventory that way, right? If your inventory pattern goes this way or this way, right? But if your inventory has a seasonal fluctuation, a lot of businesses have seasonal factor, right? Beginning of the year and end of the year, we're talking about beginning of the year and end of the year, right? Yeah, but if your inventory has this fluctuation, right, then you can't do that, right, over the, say we have 12 months period, right? So in this case, what you need to do is you add up monthly inventory divided by 12, right? That's how you can calculate average inventory level, right? It will be more accurate than this if your inventory fluctuates, if there's a significant fluctuation month to month, okay? All right, so inventory turnover, the unit is times, okay? How many times your inventory is turned over, right, compared to considering your total production cost. If it's too high, again, you have to compare it to the industry norm. It's okay. Okay? If it's too high, what's the story? If the inventory turnover is significantly higher than industry norm, what can you say?
They should make a lot of inventories.
Okay, in other words, that may indicate that your inventory level is too thin, too small. You're keeping too little inventory, right? Is it bad? Inventory is a very, very important item. You have to always watch your inventory level, because keeping inventory means you've already spent money. Either you have already produced your product, or you already purchased the equipment or the materials and supplies, components, right? But you haven't sold them yet, sold your product, right? So your money is sleeping in your inventory, in your warehouse. So you never want to keep too much inventory because that's a bad cash management, right? If you have too much inventory, that's the quickest way to go down for a business, right? Because you will be cash strapped, right? So you don't want to keep too much inventory, right? But why do you keep inventory anyway, if it's so bad? Huh? Just in case what?
Sometimes you have to refund, exchange.
Okay. Yeah, basically a customer, right? Customer, you can have some average expectations, expected sales monthly, right? But sometimes your customer may order a little more than usual, right? And if you don't keep any inventory, what happens? You have nothing to supply, right? And well, of course, there is a lost sales, right? If you can't supply to your customer, then you lose the sale, right? But that's not a problem, actually, right? The problem is your customer may go out and look for another supplier, right? And if you lose your customer, that's a big problem, right? Because that's, you're losing future sales, okay? So that's why you always need to keep a certain amount of inventory, right, of finished products, okay? How about the unfinished products, like your material and components? Why do you have to keep those things?
Raw materials the price of raw materials can go up.
Mm-hmm. That's one reason, right? So by keeping some, enough supplies, you can avoid, spiking price for some reason, right? If the material price goes up or whatever, right? Another reason is your supplier may have trouble, right? Like fire in their plant, right? It happened a couple of years ago. One of the suppliers for Kia motor plant in Georgia had a fire. It's a Korean company located in Georgia. They are operating. I think it was a metal stamping company, right? So they were supplying this frame structure to the Georgia plant, Kia plant, okay? But they had this fire shut down for the whole month, right? And what happens? Well, the entire Kia operation had to shut down, right? So that's the problem, okay? So when these companies like Hyundai or Kia Motor Company, when they select their suppliers, they are very careful. They come to the plants and they look at the floor, the plant floor. If there is a single drop of oil, right, that's a problem, okay? Because they don't want their suppliers to have any problem. All right. So there's what we call just-in-time manufacturing, right? This is actually about the inventory management, right? In the old days, because of the reasons that we talked about just now, just in case material price goes up or supplier has some accident and they cannot supply for a while, right? The companies used to keep a lot of supplies, right? The material components and so on, right? But since 1980s, Japanese guys started this just-in-time manufacturing, okay? Because it's quite expensive. Again, keeping inventory means you've already spent money, but you are not recovering that money yet, okay? So it's expensive, and it also requires a lot of space, okay? The space to store, right, these materials and components, right? So they started just in time. They're just ordering just enough to operate today, okay? To minimize the cost of inventory, right? There is a BMW plant in Spartanburg, South Carolina, which is about half hour, 30 minutes distance from the school where I'm teaching, Southern Wesleyan University. So about once a year, I take my students to this BMW plant, field trip. Okay? And this is a SUV plant. They only make SUVs. Okay? And this is, according to them, the only SUV plant outside Germany. Okay? In the entire world, there is only one SUV plant. Okay? So they produce X3, X5, and I don't know the more recent models. Okay? It's amazing. It's a huge, huge plant. Okay? And of course, it's a nice, magnificent operation. Okay? But one thing the tour guides tell us is this inventory management. Okay? They keep minimum inventory. So in some cases, they keep up to 40 minutes worth of inventory. Okay? And they say about 850 different suppliers supply to this plant. All kinds of material and components and everything, the supplies. Okay? And they all have, schedule, delivery schedule. Okay? So if one supplier messes up, right, then theoretically this entire plant can shut down within 40 minutes if one supplier misses the delivery. Okay? And that's the assembly line. Okay? So if you can, suppose you're out of headlamp, then the entire assembly line has to shut down. Okay? It will be very, very expensive. Okay? So if that happens, I guess it happens, once in a while, right? If that happens, the BMW charges the supplier $8,000 per minute. Right? Every minute they will shut down, right? BMW charges $8,000. Right? Maybe it was $80,000. Yeah, I think $80,000, something like that. Right? Yeah, so that's the idea of just-in-time manufacturing, trying to minimize the amount of inventory, because keeping inventory is very expensive. Okay? All right, so if it's too high, indicates inventory is too thin. If it's too low, that means your inventory is too much compared to the industry. Okay? Make sure you understand that concept. Yeah? Fixed asset turnover is sales divided by net fixed asset. You still remember the concept of net fixed asset? I think we talked about it last class. Fixed asset is basically long-term assets, right? Including equipments, tools, and plant, right? What is net fixed asset? Fixed asset minus depreciation or accumulated depreciation, right? Accumulated depreciation. Okay. So compared to the net fixed asset, how large is the sales? Okay. So how effectively, how efficiently they are managing or using those equipments and tools and facilities to generate sales. Okay. Of course, larger the better. Okay. And similar concept is total asset turnover. Right. In addition to net fixed asset, just include everything, right, including current assets. Okay? Compared to the total asset, how large is the sales? Okay, any questions so far? All right. Maybe do one or two more slides here. Okay? I know this chapter is a little bit boring, right? But starting from chapter 5, it'll get much more interesting. Okay? This chapter and next chapter require a lot of accounting concepts, right? But starting from chapter 5, we're going to talk about time value of money, stocks and bonds, and investments and budgeting and so on. Okay? So make sure you have financial calculator when we do chapter 5. Okay? So maybe 2 weeks later. Okay? Okay, so financial leverage management ratio. What is the leverage anyway? What do you mean by leverage? Well, we'll talk about it in more detail, but you can consider it the same thing as debt. Debt obligation. Okay? So leverage includes bonds. It also includes preferred stocks. Preferred stocks. Okay? Again, we'll talk about it in more detail in stock chapter. But basically, there are 2 different types of stocks: preferred stocks and common stocks. Okay? Preferred stocks, for many practical purposes, preferred stock is considered a debt. It's not an equity. Well, depending on how you categorize, sometimes it's considered equity, but for financial analysis purpose, it's a debt. Because when a company issues preferred stock, they promises dividend. Okay? Common stock, you don't have to make dividend payment, right? But on preferred stock, you are required to make dividend payment, just like bond. Okay? So every quarter, you are required to make dividend payment. So it's a debt obligation. Okay? And also lease payment. Okay? When you sign a lease, okay, you're supposed to make monthly or quarterly or payments, right? So typically these things are included in leverage. Okay? So in other words, how effectively you are managing your debt, or how effectively you are using your debt to generate what? Profit. Oh, I'm sorry, I'm talking about, yeah. Compared to your total assets, right? What is, forget about it, what I just said. I was thinking about, different ratio, right? So here, compared to the total asset, how large is your debt? Okay? So debt ratio is simply total debt divided by total asset. Okay? Debt to equity ratio is total debt divided by total equity. Okay? Again, well, the unit will be percentage. Okay? Well, how large is your debt compared to the asset? Okay? Now, there will be significant difference in those numbers, percentage numbers, depending on which industry you are in. Okay? I guess the easiest way to understand it is this way. Okay? When do companies borrow money? For what purpose, typically? What do you mean by investment?
Maybe some kind of pledge.
Okay, so when you operate, which one takes the most money so that you have to borrow? Huh? Yeah. If you are building a plant or purchasing equipment, building a factory, right? So those equipments, mostly companies borrow money to purchase those equipments. Large, generator. So the companies like electric company, electricity, power company, okay? They have a lot of debt, okay, compared to assets. Right? So the debt ratio is pretty high in those heavy equipment, heavy industry. Okay? The worst industry, the industry that has the highest debt ratio, is airlines. And you understand why, right? Airlines. Most of their assets are airplanes. Okay? And most of the airplanes are leased. Some are purchased, but leased. Anyway, they all belong to this leverage. Okay? So, I mean, most of the airline companies are practically in bankruptcy, right? They have so much debt. Okay? So I have a few. The difference between the debt ratio and debt to equity ratio is whether you compare that debt to the total assets and total equity. What's the difference between total assets and total equity?
Assets minus liabilities.
Right, that's right. Okay. Total equity is the difference between the debt and asset, right? Let me see. What is MSFT? Microsoft, WMT, Walmart, DUK is Duke Energy. It's the largest electric power company in the United States. GE, you know what GE is? So as of last year, typical debt equity ratio of Microsoft was 20.64. So, you know, Microsoft has a lot of cash. They just don't know what to do with cash, right? So compared to the equity, the debt is only 20%, right? Only 20%. Okay? Walmart had 74.15. Still pretty good. You know, Walmart doesn't have any heavy equipment, right? Most of their assets are in merchandise and maybe some warehouses, right? And I think most of the trucks they lease, okay? So it's not their assets, right? Duke Power had 103.26. Okay, so it's pretty heavily indebted compared to the equity, total equity. Debt is pretty large. GE debt equity ratio is 300.62. Okay, and here airlines. Most airlines. If you try to find debt equity ratio of airlines, you will find a very interesting thing. It says NA. Guess why? Does that mean they don't have any debt? They don't have any equity. Yeah? Equity is basically zero or maybe negative, right? So that's why they can't calculate debt equity ratio. Okay? All right, I guess one last item here is the time interest earned. Okay? It's EBIT divided by interest charges. You know, EBIT is earnings before interest and taxes. Another name for EBIT is operating income, right? So we're trying to find out, compared to the interest charges or interest obligations the company has to make, right? How large is their operating income, okay? So the unit would be times, right? 2 times, 3 times, whatever, right? And of course, the larger the better, okay? And financial analysis of the company. We talked about a few different ratios. We still have a few more ratios left. So why don't we quickly finish this and maybe get out of here before it rains. All right, the profitability ratios. So this measures how effectively or how efficiently a company generates its profits compared to sales, assets, and equity. Okay, so you know, how effectively the company is using the assets and equity and generating profit And we're talking about the relative size of the profit compared to sales. Okay? So the first one is gross profit margin. And apparently all these profit ratios will be measured in percentage term. Okay. Okay, that should be fine. Oh, I sent you, well, I uploaded a page about how to watch this video. Did you see that? Okay, try that and see if it works. Okay. Okay, so when you subtract cost of sales from the total sales, that's gross profit. Okay. And so if you divide that by sales, you get gross profit margin. Okay? And this reflects, gross profit margin reflects pricing, how effectively you are pricing your products, because sales revenue is nothing but P times Q, right? You know that. That's total sales revenue is simply price times how many units you sold. Okay? So, of course, as a company, you'd like to charge as high a price as possible, as much as possible, right? But what can't you charge extremely high price? Any reason why you can't charge as high price as you would like? Just trying to give you a very obvious question. What happens if you charge too much? Right, because if customers think it's too high, you may lose your competitiveness. Okay? You may lose your customers to your competitors. Okay? All right, so there's a certain range. You'd like to make it as high as possible, but you cannot go over certain range, right? So that's what we are talking about, how effectively you are pricing your output, your product. Okay? So the gross profit margin reflects your pricing effectiveness. It also reflects production efficiency. Production efficiency, right? Because cost of sales, I think I repeated it many times, it is nothing but production cost, okay? Production cost. Okay? So how efficiently you use your resources and produce your output, that is reflected in the cost of sales. Okay? So gross profit margin reflects these two concepts in your management, in your operation of the business. Okay? Net profit margin is net profit divided by sales, okay? Or what we call EAT, earnings after taxes. In other words, it's net profit. Okay? And that EAT, the difference between the gross profit and net profit is, well, there are a few things. You have to subtract operating cost, okay? And also everything, basically, your interest charges and taxes, right? So it reflects all expenses, not only the production operation, how efficient your financing is. Yeah? In other words, when you raise your capital, are you getting the capital, obtaining the capital at as low as possible interest rate, okay? And lowest possible interest rate. Related to net profit margin, we can think about another profit margin which is not here. Okay? You can think about operating profit margin, okay? And that is simply EBIT divided by sales. What is the EBIT? Earnings before interest and taxes. Okay. And what's another name for EBIT? Operating profit, okay? Because this is profit before you pay interest and taxes, right? So simply this is a profit you generate out of the result of operation, right? What do we mean by operation? Production and sales, okay? Before you think about your financing cost and everything, right? Okay, so that's the operating profit margin, which is slightly different. I guess you can put it right in between the gross profit margin and net profit margin. You can think about operating profit margin, okay? So gross profit margin just thinks about production cost, okay? Operating margin thinks about production cost and other costs, SGA, I told you last class, right? Sales, general and administrative costs, operating cost, okay? And net profit thinks about everything, right? Production cost, operation cost, and financing cost, and taxes, everything, okay? That's the difference, okay? All right. Excuse me. The next item is return on investment, ROI. I'm sure you have heard of ROI, right? Return on investment. That's net profit divided by total assets. So it reflects how effectively you are using your assets to generate profit, or how much return you are making out of your investment, okay? Investment of assets, ROI. And then finally, we have ROE, return on equity. Okay? Return on stockholders' equity, but typically we just write it ROE, right? Return on equity. Okay? That's EAT divided by equity. So the only difference between the two is one is divided by assets, one is divided by equity, okay? Stockholders' equity. So for one company, for the same company, which one will be larger? Between ROI and ROE, which one will be larger? I hear both. ROI or ROE? Which one would, which one would be larger? ROE, why? Exactly, right. Remember, we had this assets, liability, okay? On the left-hand side, we have total assets. On the right-hand side, we have liabilities plus equity. Sorry. Okay? So that means equity will be smaller than assets because just about every company has liability, right? Even Microsoft has liability. In other words, some debt, okay? All right. So we're dividing the same thing with assets or equity. So ROE is typically larger than ROI. Okay, that's the relationship. Okay. All right. So far, we've talked about many different ratios, financial ratios, but you can call them accounting-based ratios because those figures, whether it was income, profit, assets, the current asset and so on, current ratio or whatever, the ratios we talked about, okay? Those were based on books or accounting figures, accounting books, okay? But here we have slightly different ratios, different concept. It's called market-based ratio as opposed to accounting-based ratio, okay? The difference is this. accounting-based ratios are, well, I guess, aren't directly related to SW. What is SW? What is SW? Shareholders' wealth, remember, right? That's the ultimate goal of financial manager, right? Maximizing shareholders' wealth. Okay? But accounting-based ratios aren't directly related to shareholders' wealth, because shareholders' wealth, how do you calculate the shareholders' wealth? If you remember. Okay, what? Earnings per share? Well, before we go there, it is a price of each share times number of shares outstanding, right? So if you have million shares outstanding in the market, and if the current market price of the share is $10 each, right? Then the shareholders' wealth is $10 million, right? $10 times million shares, all right? So as you see here, shareholders' wealth depends on market price of shares. I should say market price. Market price of shares. Okay? So accounting-based ratios, whether it was a current ratio or profitability ratio or debt-asset ratio, whatever, leverage management ratios, okay? All those things are nice. I mean, those are nice indicators of how a company is performing, right? But they are not directly related to shareholders' wealth, okay? Because what matters in shareholders' wealth is price of shares, okay? So how is price of share determined? Who determines the price of the shares? Market, okay? What is market and who is market? What do you mean by, yeah, supply and demand, that's right, supply and demand. Right? So we have people who demand or people who are trying to buy stocks versus people who are trying to sell, right? And that's how the market price is determined, right? Well, of course, they look at everything like earnings per share, right? How profitable the company is. So if the profitability of the share is good, if that number is good, then they will tend to raise. Please keep quiet. I'm a little bit bothered by this. Sorry about that. Okay? So, you know, profitability share or debt ratio, everything matters, right? But there are a couple of things that market consider in addition to those ratios. Okay? That is risk and future earnings potential. Future earnings potential. Okay? So these two concepts are not directly related to an accounting concept, right? But apparently, you know, when people buy and sell, obviously, they consider how risky a company is, the investment is, right? And what the future earnings potential is for a company. Okay? So that's what market-based ratio, or more specifically market price, reflects, you can say, right? All right, so we're going to talk about two market-based ratios. First one is price to earnings ratio, or more simply, we just call it PE ratio. PE ratio, okay? And that is the market price divided by current earnings per share, or EPS. EPS. We talked about it. EPS. How do you calculate EPS? Earning. What do you mean by earning? More exactly, there are many different earnings, right? Gross profit. No, I mean in terms of calculation, we divide something by number of shares outstanding, right? What do we divide here? More exactly in net profit or EAT, right? Right? EAT divided by number of shares outstanding, that's EPS, earnings per share, right? All right, so if you divide the current market price by EPS, that's what we call PE ratio, price earnings ratio. Okay? And that's a very popular indicator among the investors. Before you buy any stock, you should certainly examine their PE ratio. Okay? And the thing is, just like many other financial ratios, there is no concrete criterion. It depends on what industry you're talking about. Are you talking about software industry, or are you talking about financial industry? Okay? So industry norm is important. In some industries, like very high advanced technology industry, right? A few years ago, before the satellite radio started operated, I guess we're talking about maybe 10 years ago, right? The satellite radio companies were still preparing their first operation, okay? But they've already issued the stock, okay? And they were selling their stock, right? And stock prices were pretty high, okay? But their earning was zero because they haven't started operation yet, right? They were not making any money, right? So EPS was basically zero, right? But their stock price was about $100, right? So PE ratio would have been what? Infinity, right? As, you know, thousands of whatever, right? All right, so it depends on, you know, what industry you're talking about. Okay? The other market-based ratio is price to book ratio, or more exactly, market price to book value ratio. But, you know, typically we just call it price to book ratio, right? That's the ratio between the market price of the stock divided by book value per share. Okay? I think I mentioned book value once before, right? What do we mean by book value? Book value is, in essence, the value of the company which shows up on the book, right? Or financial statement. Which statement? Balance sheet, right? So if you look at the balance sheet, you have assets, liabilities, and equity, right? This section, shareholders' equity, right? That's what we call book value of the company, book value of the company. Because out of the total value of the company, when you subtract liability, right, you can say this is the net worth of the company. Okay? So, or according to the book, anyway. Right? And book value has nothing to do with market value. I mean, they are not directly related, right? Right? So we'll think about the ratio between the market value per share and book value per share, right? That's what we call price to book ratio. Okay? Here, let me write down just some words of warning here. Okay? Book value is affected by accounting practice. By accounting practice, what we mean by are inventory, inventory valuation and depreciation method. Different companies have different accounting practices. Okay? So the way they value their inventory can be all different. I think I talked about inventory in the maybe first class of this chapter, right? Inventory is an item which is very illiquid, okay? Not very liquid. Okay? And so you have to be careful how you evaluate inventory. So that's the concept of acid test, right? What is the acid test? Current ratio and quick ratio, okay? So if you subtract inventory from current asset, right, and divide by current liability, that's quick ratio. That's what we call acid test. Okay? So the reason why we do that is inventory is rather unreliable. You cannot really trust, right, that you can convert the inventory into cash quickly and in good value, right? So depending on how you measure, how you value your inventory, it can be all, you can have quite a variability in there, right? Depreciation practice still, it also varies from company to company, right? I'm not an accountant, but there are many different ways. First of all, FIFO, first in, first out, right? And some other, you can use many different methods, right? It's quite complicated accounting practices, right? I will not go there, right? So you have to be careful comparing book value of one company to another company, right? So whenever you are dealing with the book value, you have to be careful. In other words, whenever you are dealing with the stockholders' equity of a company, right? It is generated by accounting practices, right? And depending on how you measure all those things, book value can be quite different depending on who measures book value, right? So you have to be cautious in comparing this price to book ratio over different companies. Okay? You can use within the company, these figures within the company from last year to this year, what happened to book value. As long as you maintain the same practice, same method of inventory valuation and depreciation, you can accurately measure what happened, right, within your company over the years, right? That's fine, okay? But, be careful when you compare company across different companies, okay? I think I said enough of that. All right, finally, dividend policy ratios. This is about the dividend, right, share of the profits. And first one is payout ratio. You divide the dividend per share by earnings per share. So per share basis, how much did you earn and how much you paid out? If you earned, say, $1 per share and paid out 50 cents per share as the dividend, dividend payout ratio would be 50% or 0.5. Okay? Dividend yield is a slightly different concept, right? This is expected dividend. I'm sorry. This should have been dividend, not divided. Expected dividend per share, okay, divided by stock price. Expected dividend per share divided by stock price. Okay. All right. So I think I mentioned it before again, but there are two different types of stocks: income stock versus growth stock, right? And I couldn't remember the name of the company, one of the income stock company. The company produces tobacco, right? Did you get it? Philip Morris is one of them. R.J. Reynolds is a company that I was thinking about. R.J. Reynolds, right? Yeah. R.J. Reynolds is considered one of the very staple, main, reliable income stock, because every quarter they pay out the dividend regularly. Okay? So you can depend on the R.J. Reynolds dividend as a part of your income. So firms with stable earnings, apparently, they're doing good business using, from the tobacco business, right? And they're making good income, very stable income, right? So that's how they could pay out the dividend regularly without missing, right? Firms with continued capital investment, in other words, firm is just growing fast right now, right? Or it requires consistent or constant capital equipment. You constantly have to update your equipment, build a new factory, and hire new engineers and so on, right? Then those companies tend to miss a lot of dividends, okay? Because they have strong need for reinvestment. Okay? So let me write down one other statement here. Since market price reflects market's expectation, on future growth, low dividend yield, DY stand for dividend yield, okay? Low DY often indicates high future growth. See if that makes sense. We're talking about dividend yield here, expected dividend per share divided by stock price. Okay? Since market price, we're talking about market price of the stock, right? Market price of stock reflects market's expectation on future growth. Okay? Low dividend yield often indicates high future growth. Okay? So that's the market's expectation. People, when they invest in stock market, they are not dumb. We're talking about lots of money, right? So most people do due diligence. And I would say majority of the stock investments are done by institutional investor. There are institutional investors and individual investors. You know the difference, right? If you open up an account and e-trade and put your own money and trading, that's individual trader, individual investor, right? But there are lots of institutional investors. In other words, the companies, this finance companies, banks, insurance companies, pension fund companies, right? All these companies have their fund managers and professional investors, right? And these people do their due diligence, and they know a lot about the companies they invest in. Okay? So what they mean, what they do is they think about the expected dividend per share in the future, right? And they understand that since this is a technology company and this is a company that grows fast, right? In the future, in the near future, they may not pay a lot of dividend, okay? Which is acceptable in that sense, right? If the company is growing fast. Okay? All right? Well, you have to be careful here. Whenever you deal with financial ratios, right? You have to understand. So if a ratio is high, you have to understand there could be two different reasons, right? If ratio is high, it could be because numerator is big, or it could be because denominator is small, right? So whenever you deal with the ratio, you have to have that understanding. It's the same thing here, right? If the dividend yield is high, right, then it could be because people expect high dividend per share, or current stock price is low, right? So is it good or bad if dividend yield is high? Exactly, you're not sure. You have to find out, right? What's the reason if you have high dividend yield, right? Is that because expected dividend is high? Well, could be a good sign if you are looking for an income stock, right? But that may not be what you're looking for. If you're looking for future growth of the company, right? If the company grows fast, then stock price can appreciate fast. If that's what you're looking for, you don't necessarily want a high dividend, right? You want the company to reinvest and grow fast, okay? If dividend yield is high because stock price is low, right? And that may indicate markets not thinking the company is very good, right? If the stock price of the company is low, right? So you need to find out exactly why any ratio is high or low, okay? All right, so now we are done with those, ratios, okay? And just a few things to talk about before we end the chapter, right? The first one is trend analysis. In addition to just looking at those numbers at the moment, right? Well, sometimes you need to look at the trend. Here we have an example of 3-year trend, okay? So you need to find out what's happening, where we are headed, right? That's always an important concept, right? Are we doing better or worse than before, right? That's the idea of trend analysis, right? In statistics, we call it time series analysis, right? Time series. You can construct a chart, okay? Whatever the number is here, and you can put time here, okay? Sometimes you need cross-sectional analysis. In other words, you compare a particular company of your interest to industry norms or perhaps to other company, right? That's another useful comparison, okay? And sometimes we do both time series trend analysis and cross-sectional analysis, okay? So in statistics, if you learn, we have cross-section data, time series data, or sometimes we have data that have both figures, right? Both time series and cross-section characteristic. Does anybody remember the name of that kind of data? It's called the panel data, right? If you look at different individuals or different entities across different time, like this, we have 2 different companies or company versus industry across different times, okay? This is called the panel data. Okay? All right, so that's the idea of trend analysis. Simple idea, okay? And in addition to constructing the tables, we can also construct the charts. And usually it's easier to look at or grasp the concept, what's going on, okay? So here we have quick ratio of Drake company versus industry across different times. And we find out that, well, even though Drake company's quick ratio has been declining over the years, it's not alone, right? Apparently, entire industry is going down in terms of quick ratio, right? However, when you compare the debt ratio of different companies, the Drake and the versus industry, we see there is wide gap or widening gap or divergence, okay, between the Drake company and industry. Okay? So this is what we call trend analysis. You can catch exactly what's happening by doing some trend analysis. Okay? Any questions so far? All right. DuPont analysis is a quite interesting concept. This is started by DuPont Corporation. I'm sure you have heard of DuPont Corporation. This is a chemical corporation, right? Produces a lot of chemical components and products. Okay? It allows focus on individual segment. Allows focus on individual segments of performance measures. Performance measures. Okay? So many times it's called the component analysis. Component analysis. So rather than just looking at one item like ROI or ROE, right, it decomposes these ratios into more detailed components, right? What is EAT divided by sales? We just talked about it a few minutes ago. EAT divided by sales. Net profit margins right there, right? Net profit margin. Right? And sales divided by total assets. We talked about it last class. It's called the total asset turnover. Simply the ratio between sales and total assets. Right? So if you multiply this one by this, and of course sales cancel each other, right? And it becomes EAT divided by total assets, which is ROI, return on investment, right? So, you know, previously we just talked about ROI being EAT divided by total asset, and that was one of the profitability measure, right? And based on this number, we could get some sense on how profitable the company is or how effectively the company manages its assets to generate profit. Okay? But when you decompose or separate this one figure into two components, we get some new insights. Okay? Let me give you some numbers. Walmart ROI is 8.32. Right? Duke Energy is an electricity power company, right? The ROI is 5.81. So they are slightly different. One is about 8, the other is about 6, right? So return on investment is slightly different. Okay? But when you decompose this into net profit margin versus total asset turnover, you find out quite an interesting thing. Okay? net profit margin for Walmart is 3.62, and the net profit margin for Duke Energy is 9.23. Okay? So in terms of profit margin, Walmart is making a lot less profit margin. Think about it. I mean, if you go to Walmart store, typical Walmart store in the United States, well, it's a huge store, right? There are probably 500,000 items in a store, right? And I would say 90% of them came from China. Okay? And they are cheap, very cheap, right? So when Walmart sell these items, my guess is in many items, they don't even make a single cent, not even 1 cent per item, right? The profit margin is, I'm sure there are lots of items that you have to sell many units to make 1 cent profit, okay? But Walmart, as you know, is what's the ranking these days in terms of total sales? A few years ago, it was number 4, okay? But I'm sure it's probably number 3 or number 2 these days, okay? In the entire world. Okay? So how are they making so much money when their profit is so razor thin, right? They are doing a lot of business. In other words, they're mass purchasing and mass distribution. That's the secret of Walmart. Okay? So even though their profit margin, net profit margin, is very small compared to other company, right? When you look at their total asset turnover, okay, that's 2.3. Okay, in terms of sales divided by total asset, sales is more than twice large as their total asset, 2.3, right? But total asset turnover of Duke Energy is 0.63. Think about what makes this difference, okay? We're talking about this item, sales divided by total asset turnover, okay? For Walmart is 2.3, okay? For Duke Energy, it's only 0.6. What makes so much difference? Yeah, well, it's an obvious concept. I mean, compared to the assets, Walmart generates a lot of sales. Okay, Walmart is a merchandising company or distribution company. They purchase things and just distribute. That's it. They don't produce anything, right? They don't need any equipment. They don't need any factory, right? All they have are some warehouses or what they call distribution centers. Okay? And well, they have thousands of trucks, but I'm sure most of them are leased, right? They don't own the trucks. Okay? So their asset is pretty limited, right? So compared to assets, their sales is more than twice as large. Okay? But in terms of when you think about Duke Energy, power company, right? They need a lot of assets. You have to have power plant, generating plant, right? Could be a nuclear power plant or any other, coal-burning power plant, right? But these power companies have a lot of assets, okay? So even though they generate a lot of sales, I mean, it's the largest power company in the United States, right? So if you go to a place like North Carolina, Charlotte, North Carolina, they're the only power company, right? The entire city's power is supplied by Duke Energy, right? And not only North Carolina, but in California and many other states, right? The power is supplied by Duke Power, right? So their sales is, I'm sure, enormous, right? But their asset is even larger. They have to have a lot of assets, right? So the story is this, right? When your sales profit margin is very thin, you better have a lot of asset turnover, right? To make up for the small profit margin. That's how Walmart has 8.3 return on investment, okay? Case like Duke Energy, when the company has a lot of assets, requires a lot of assets, heavy investment, okay, compared to sales, right? Then they better have good profit margin, right, to make up for that low turnover, okay? And that's how they maintain 5.8 return on investment, okay? So by decomposing ROI into two components, you can look at different aspects of these businesses. Is that right? You understand, right? The point of DuPont analysis, right? Component analysis, okay? How about ROE? ROE is, well, as you know, EAT divided by equity, the ratio between net profit and the stockholders' equity, right? But you can rewrite it this way. You can write it as net profit margin times total asset turnover times equity multiplier. Equity multiplier is simply the ratio between total assets and equity. Okay? And equity multiplier reflects the degree of debt financing. Equity multiplier here, I guess. Reflects degree of debt financing. Why? How can we say that? You know the relationship. Total assets is liability plus equity, right? Total assets is liability plus equity, right? So if you have larger debt, what happens? What happens to equity multiplier? Huh? It gets bigger, right? If you have larger debt, liability, right? That means compared to assets, equity is small, right? So the ratio between assets and equity will be large, okay? Make sure you understand that relationship, right? So equity multiplier reflects or measures degree of debt financing, how much debt the company has, right? So if the company amasses more and more debt, then equity multiplier rises, right? And that's a very interesting thing. You know, this multiplied by this is ROI, as you see here. So ROE is simply ROI times equity multiplier, right? All right. So what that means is this. A larger equity multiplier increases return on equity. And that's basically what the investors look for, right? If you are an investor, if you are purchasing Microsoft stock, right? Then what you're looking for is compared to the stock value or value of the stockholders, right? The company must make a larger profit, right? Return on equity, right? That's what the stockholders want, higher return on equity, right? So what that means is larger equity multiplier. In other words, if a company takes on more and more debt, right, that increases ROE. You can do that, right? But at a greater risk. Okay? It becomes riskier when the company takes on more and more debt, right? Why? Again, I'm asking an obvious question, but can you explain? Why does it become riskier when you take on more and more debt?
Because you have more to pay back.
Right. Your interest payment goes up, right? So interest payment will be larger and larger. Interest payment will be deducted from your revenue, right? Which means your profit should go down, right? And eventually, if in case business goes down, in other words, the economy goes into a recession, right? And your revenue goes down, right? That doesn't mean your interest payment will go down, right? Because you have signed your loan contract, right? Doesn't matter how much money you make, you have to still make the interest payment every month or every year, right? So in the worst case, you may not have enough money to make the interest payment, right? And that means you may have to declare bankruptcy in order to protect yourself, right? So that's the idea. Of course, it's an obvious concept, right? But that's the idea of leverage. Last class we talked about leverage, right? And at that time I told you it's basically debt, right? Loan, like bond, right? Bond issued, preferred stocks, lease payments, right? All those things are leverage, right? But why do we call that a leverage? Okay? You know what leverage is. You have a bar here, okay? And when you press down on this side, you can easily lift heavy objects on this side, right? This is what we call leverage, okay? And this, does the length matter? Yeah, I'm sure you're good with the physics, right? The longer the better, right? The longer the easier to push down. You need less power to push it down to lift the heavy object on the other side, okay? That's what we mean by, that's the idea of leverage, okay? This is debt, okay? The more debt you take on, it's easier to generate profit. But it is dangerous, right? The longer the bar, it can easily break or bend, right? You can understand it that way, right? All right. So that's the idea of DuPont analysis. You know, we can do some component analysis on ROI and ROE, and we can understand the relationship between the profit margin and asset turnover, right? And then we also bring in the concept of equity multiplier. What happens when you borrow more and more, right? So typically a company, when a company borrows more and more, ROE goes up, which looks good in the first hand, right? You know, companies generating a lot of profit for equity, right? Investment, right? But you have to understand there is a hidden risk, right? Okay? So the next chart is in your textbook, in your chapter, right? It's just an illustration of the DuPont analysis. Start from total expenses, cost of sales, operating expenses, interest charges, and income tax, right? And if you subtract all these expenses from sales, it come up with the earnings after tax or net profit. Okay? When you divide net profit by sales, it becomes net profit margin. Okay? On the bottom side, we start with the current asset, cash, marketable securities, accounts receivable, inventories. Okay? And to the current assets, if you add fixed asset or net plant and equipment, we come up with the total asset, right? All right. So from here, we have net profit margin and total asset. When you divide the net profit margin with the total asset, becomes ROI, return on investment. Okay. All right. And then when you multiply the return on investment by equity multiplier. It says total access to stockholders' equity, right? But this is nothing but equity multiplier, right? Then you finally end up with ROE, okay? So, ROE is a very important measure, and when investors make decision whether they're going to invest or not, right? They look at ROE first, okay? But again, there are some story behind ROE. You have to understand a company can artificially inflate ROE by borrowing more debt, borrowing more, okay? Taking on more debt. All right, so here are a few cautions using the financial ratio analysis. Ratios are only as reliable as accounting data on which they are based. GIGO. What is it? GIGO. Really? Never heard of it? Usually they use it in computer science. Garbage in, garbage out. Right? Garbage in, garbage out. Right? If your accounting data are unreliable, then your financial ratio analysis are useless. Okay? That's it, right? Be cautious of using industry norms without considering some measure of dispersion. Okay? So, something like average day of collection, right? And you have 30 days on average. Industry norm is 27 days, right? So there's 3 days different. Is it really bad? Well, not only the mean difference, right? You have to also understand the dispersion or standard deviation, how widely. The central location is important, but the width of the distribution is also important. Okay? In other words, the industry norm may be 27 days, okay? But the standard deviation may be 10. Okay? So that means the distribution is quite wide. Okay? There are a lot of variability among the companies in the same industry. Right? So then 3-day difference may not mean much. Okay? So you have to understand the effect of dispersion. Right? Comparative analysis depends on the ability of data for each industry. Well, that's an obvious thing, right? If you don't have data available on industry, then you cannot compare, right? Ratios look at historic information, what already happened, right? Be careful extrapolating into the future. In other words, what happened in the past may not necessarily be the story of what's coming, right? It may not be a good indicator of what's going to happen in the future, right? So you have to have some insight, okay, on those things. All right, so I think we have enough time now, okay? So this chapter ends with a couple of alternative measures of performance, okay? and talks about market value added, MVA. Okay? MVA, well, here's the definition. It's the market's assessment of the company's worth over and above the value of all investments since the inception. Okay? So market value, you know how market value is calculated, remember? In other words, it's the same thing as shareholders' wealth, market value of the company. You multiply the current price by the number of shares. Okay? Subtracted by capital. Right? Here, capital can be considered the same thing as book value of equity. Book value of equity. Right? Book value of equity in essence, you can say book value of equity measures all cash and retained earnings invested since the inception of the company. So let me see if I can. Here we go. Here's a balance sheet you've seen before, right? And the last section here, starting from here, common stock, $10 par value, contributed capital in excess of par, retained earning. This section, these three items represent book value of the equity, right? Book value of the company, right? So what that represents is, okay, so here, when the company started out, let's say the company started and issued the stock just once, right? And apparently they issued the stock with a $10 par value, right? A couple of students had a question on par value. As I said, par value is meaningless, okay? Because corporation issues stocks, okay? Stocks must have some value. Again, we're not talking about market value, but the book value, right? So you can assess the value of the stock at any price, right? Let's say instead of $10, I said $1 par value, right? Then it's going to be, instead of 13,000, it's going to be 1,000. I'm sorry, this is 13 million, right? Because the unit is $1,000, right? So instead of 13 million, it's going to be 1.3 million, right? So what's the difference? 13 million minus 1.3 million. So 11.7, right? Is that right? Yeah. You can add 11,700,000 to the next item, contributed capital in excess of par. Okay? Doesn't really matter because this one, the first item is artificial, right? You have to declare value of the stock, right? And if you read the chapter, you would understand why they recommend minimum value. And some companies these days, they don't even declare any par value, okay? So anyway, so that's how, you record the stock value and whatever the amount you invested, okay? So here, in this example, contributed capital in excess of par was 10 million, right? So if you add 10 here, so total investment apparently in this company when it started was 23, right? So 13 million plus 10, right? So here, if you par value of $10, then it's going to be 13 and 10, right? If you use $1 as a par value, it's going to be 1,322 or 21,700. Doesn't really matter, right? Par value of the stock will be 1,300,000. Right? The investment in excess of par will be 21,700,000. Right? The next item is retained earning. Retained earning is over the years. Maybe the company existed the last 10 years, right? And over the years, out of their profit, how much they retained without distributing as the dividend, right? So that's what this is about, right? So when you add them up, these three items, that's going to be the amount of equity or cash and retained earnings invested since the inception of the company. Make sure you understand that concept, right? Book value of the company, right? This section represents all cash and retained earnings invested since the inception of the company. Okay? All right? So when you subtract book value from market value, that's what we call market value added. Okay? And here, what's the difference anyway then? Right? Book value of the company is, let's say, $100 million. Okay? But according to the market, it's $500 million. Right? So there's a, let's say, difference of $400 million. Okay? Well, that's market's assessment. Apparently, market considers this company a lot worth a lot more than the book value. Maybe it looks at the future earnings potential, right? Okay. That's the idea of market value added. All right, the last slide is economic value added. It's a slightly different concept. Economic value added is net dollar return after deducting the cost of capital. Okay? So R minus K. R is the return on total capital, rate of return on capital. K is cost of capital. Cost of capital is actually the subject of next semester when you take Finance Economics 2. Okay? You will learn more about the cost of capital, WACC, weighted average cost of capital. Okay? But you don't have to worry about that now. You can just understand right now as the rate of interest at which you can borrow money. So when a company raises capital, suppose you need to buy a truck, huge truck, right? 18-wheeler truck, right? So you need, say, $100,000, right? And if you go to the bank or if you talk to your investor, at what interest rate can you borrow this money, right? So if the market charges, say, 7% interest on the money you borrow, that's 7%. Cost of capital to you is 7%, right? And obviously, you better make higher rate of return on that money, right? You understand what I'm saying, right? So cost of capital is rate of interest rate at which you can borrow money, right? And R, that's the return on your capital, right? So
We count this with the percentage?
yeah, should be percentage, right? Right? No, these are percentages, right? Right.
In R and K. R and K.
Right, R and K are percentages. Or could be fraction, if you're making 10% return, it could be 0.1, or 7% would be 0.07, right? So times capital, right? That's the economic value added, right? So one thing, final comment here, is this. Sorry, my voice is going today. I was a little bit sick over the weekend, and I'm not perfect condition right now. MBA is the present value, PV stands for present value, of all expected future EVA. MBA, market value added, is the present value of all expected future economic value added, right? Well, expected value, economic value added, as you see here, this is annual measure, right? So it is typically measured per year, right? So in a year, how much capital you raised, what was the cost, and how much profit, how much return you generated on that capital, right? So EVA, right? And then you add them up, all future EVAs, okay? Okay? And divide it by 1 plus R, something like that. Don't worry about it. This is the topic of chapter 5. You discount these future values into present value. Okay? So this is expected. Who are the expectors? The market. So again, market value added is what's expected by the market. So considering the future growth potential, future economic potential of the company, the market assesses market value of the company, right? Obviously, if the market thinks the company is good, has good potential in the future, the market price will go up, right? All right, sorry, I went a little bit over. Any question?